With a presentation by Omar Khan, manager at Badri on the life and general insurance industry trends and insights. Please give them a warm welcome.
Thank you for joining us today. My name is Omar Khan and I am one of the actuaries working in Badri's Karachi office. Badri, as you know, publishes annual and quarterly industry reports both for the general side as well as the life side. So we have arranged a session here. We would want to give a summary of the industry highlights. We have gathered highlights for the life industry as at 2020 and as for the general side as at 2021. So it's just a recap of where the industry is in terms of premiums, losses, claims. Is it better now? Yeah. Thank you so much. So it's just a summary of the premiums, claims and loss ratios of the industry, where we think the industry is headed, and this suits our theme as well, which is about the industry way forward. So I just start my slide with a quick question, and the question is, how many of you are aware of the insurance cycle or the underwriting cycle or the cyclical nature of insurance business? We have a question or a poll for this in the Menti website. So if you all can log in to menti.com and see the question there, it asks for a yes or a no, and we'll see the results on the screen once we are done. So we have around 45 responses. We'll probably wait a couple more seconds and then show the results. So good to see that majority of the population here, they are aware of the cyclical nature of insurance. The ratio is around 40:15, which is healthy to see. I think this will pan out. So the reason for asking this question is we tested out this cycle for Pakistan just to see how the industry here follows the cycle and at what stage of the cycle it is currently at. We did that for the general business because general business is generally short term, and it's easier to see how the performance is moving year on year. So we have this graph here, and this is taken from the IFP data, and it shows the companies coming under IFP, the total aggregate net premium for those companies, and the total net losses along with the loss ratio. And we can see a very clear trend here for the Pakistan GI market. This is something that we had expected. Just as a background on the theory side, the insurance cycle says that the cycle can start from a hard market or a position where the insurance rates are very high. The higher profitability in the market, it attracts more participants, or the existing participants expand their capacities. As the supply increases, there is a downward push on the prices, and insurers start making losses, and there is a point in time where they either start contracting capacity or they start exiting the market, and then the cycle continues. So we can see here for Pakistan, the cycle was peaking sometime around 2007 and 8, and that period saw two shock losses, one from the Benazir incident in 2007, and then one via the 2010 floods. And thereafter we observed a very clear downward trend in the market loss ratio. So basically you can say that this was a hardening of the market. So a lower loss ratio would mean higher profits for the insurers. So the market continued to harden as per our analysis up until 2016 and 17. And thereafter we have seen that the aggregate loss ratio for the market has started to trend up again. And you can see again since 16 and 17 onwards, there is a very clear upward trend in terms of the aggregate loss ratio. So what we can say is the market is moving towards more and more softening as the years are passing. It's yet to see how long this cycle will continue. In terms of the time period when it reaches the peak again, but this is something that we feel the insurance industry can keep in mind when strategizing, when entering into new lines of business, any capital decisions they have to make, any expansion decisions. So this should be one of the key considerations going forward. Moving on, I'll just quickly show some stats on the insurance penetration and density in Pakistan. At the moment, this is just for the general side. We have the life slides later on. So the density is averaging around 350 PPR at the moment. Similarly, if you see the penetration, there has not been a lot of variation in the prior years, but recently we saw a small drop. As you all know, 2020 was an unusual year in terms of COVID-19. The number of new projects coming in went down, number of expansions went down, there were a lot of budgetary and cost constraints for certain companies. So we have seen this slight dip in both the penetration as well as the density. Moving on, so basically just before we start the slide, the analysis that we have is just for the listed GI companies. There are around 16, 17 GI listed companies which we are able to gather data on a quarterly basis, and we're presenting them here. They include a number of large and even medium-sized players which are not included because they are unlisted. This slide shows how the total market premium has been moving over the years. 2017 to 2020 did not see a lot of growth. In 2021 we have seen a rise, and mainly one of the contributing factors can be that things which were held back in 2020 because of COVID, they were released in 2021, and we saw this increase in total premium for around a double-digit increase. So the numbers we have here are 9 months. So we recently had a cutoff in September 2021. So all these figures you are seeing here are 9 months versus 9 months. Similarly, just very quickly, we have a split of how things are different between conventional and takaful. Takaful, as you know, got a major boost back in 2015-2016 when window takaful operations were allowed. And you can see here initially the growth in terms of percentage was quite high. Things then looked like it was stabilizing in 19 and 20. But similar to conventional, we've also seen a good growth on the takaful side for the GI industry. Again, takaful, we'll discuss this later in more detail. Takaful, the expansion we've seen in takaful has come from different fronts. There has been cannibalization of the conventional business, as well there's a small amount of new takaful business as well from people who are now buying insurance because there is a more better way out for them as per them. Moving on, just very quickly on the split of conventional and takaful right now in the market. We have seen that slightly increase over the years, but it looks like the split has stabilized over the last 2 to 3 years, and takaful is roughly around 10 to 12% of the industry at the moment. Moving on, we'll show very quickly how some of the companies are lined in terms of their premium sizes. If we now again, this is just listed companies, so a lot of large and medium-sized players might be missing here, and advance apologies for that. So if you see the companies here, the top 5 companies as per the listed criteria, they are constituting around 80% of the market premium. One of the good things to be observed here is most of the companies saw double-digit positive growth in 2021. So in the previous slide when we saw the market premiums increasing, it can be attributed to growth carried forward from all the companies, both large size, medium size as well as smaller players. A summary of how the lines of business are split across the market. As we know, primarily companies split their business across 4 to 5 or 6 categories in their published accounts. And fire and property damage, as you all know, continues to be the dominant line. In terms of net premium, it's slightly lower because a large portion of fire business, given the capacity issues in Pakistan, given the high reliance on reinsurance, it translates to a lower net amount, but fire and property damage still continues to be the lion's share of the portfolio. Again, motor is a big business here now, and it's coming at number 2nd. Motor recently has seen very good loss ratios in the aftermath of improving law and order situation, especially in this city. We have seen motor loss ratios hovering in the range around 40 to 50%, and motor is one of the cash cows for a lot of general insurers because of this reason. Then we have marine and health and accident, and all the other lines are clubbed into others. A lot of big health portfolios might be missing in this graph because some, as I say, are unlisted. Some very large health portfolios are done by life companies as well. So the number might be looking a lot lower, but it's actually quite handsome in terms of total rankings. Again, I was mentioning about net premium. Ultimately, the net underwriting profit, which translates into earnings as well as dividend, comes from the net premium revenue. On the net side, as we saw previously, lines of business like medical and motor are primarily retained, so they are serving as the cash cow or the main contributor for net premium in Pakistan. Fire also is a big contributor, but in relative terms, compared to its cost premium, the retention ratios are generally low. If we talk about Pakistan, a company writing on average 100 million of fire premium would, after catering to all kinds of reinsurances, would hardly be retaining 25 to 30 million of premium. Whereas in motor and medical, things run to in the late 90% or even 100%. So that's where the composition of this net premium comes from. Things on the net side, as we see, have been more stable, and the growth that we saw on the gross side has not fully translated to the net side, given the lines of business retention ratios I explained. Moving on to the performance of the portfolios, we have the gross loss ratios of the industry here. We saw a jump in 2020. There were a couple of large market losses which were shared by a number of insurers. Again, because this is gross loss ratio, the large losses had a direct impact, and we can see the losses are jumping from 38 to 48, whereas the effect on the net side is less pronounced. The ratios look very healthy in terms of margins. If we see 40 to 50%, but in the later side, when we look at the expense ratios and the commission ratios, we'll see that the margin significantly reduces. So I'll just show those slides to you. So we have the net performance here, the net loss ratio and the net combined ratio. We have seen more or less the net loss ratio have remained stable in the late 40s, and the companies are adding around 40 percentage points more for expenses and commission. And we have seen the margin that they're currently getting from the insurance business side is around 10 to 12%. The total margin that we observe on the Takaful side is very similar, although we observe that on the loss ratio side, Takaful is slightly on the higher side. One of the contributing factors can be Takaful portfolios are at the moment much smaller than conventional ones, so the volatility that we observe on the Takaful side is much higher. So this is the slide I was mentioning earlier, a split of how the expense base of the companies in the industry are split out. A major portion is going towards management expenses. Again, these are net commission expense ratio and management expenses as a percentage of net premium. So the base or the denominator for all these items is net. Commission, generally if you see for some lines, commission run much higher, 15%, 20%. But because this is net commission, it caters for reinsurance commission as well. So the average commissions we have seen on the net side are around 6 to 8% for the market. Whereas on the management expense ratio side, things have been more stable in the early 30s. Moving on, just in the interest of time, I'll just cover these slides very quickly. In terms of the underwriting profitability, we saw a consistent dip in the overall profitability or the overall nominal profitability of the market from 17 to 2020. The jump that we see in 2021 is both due to volume increase as well as an improvement in loss ratio like we saw previously. Very quickly, a summary of the investment income. Now, as we know, in Pakistan, a lot of the general insurers are relying on the investment income. If we talk for a ballpark figure, I think on average 75% of the profits are coming from the investment side, and how things move on the financial market end, they do have a big impact on how the companies are performing and what profits and dividends they are declaring. But this is a snapshot of the total investment income of those markets. The cycle, if you see it, very closely resembles the cycle that we have seen in the equity market side in terms of the highs and the lows, as well as how the interest rate in the economy has moved, where we have seen quite haphazard movements over the past 3 years, where it was increased and it was then decreased, and now it's going back up again. Just skipping some slides because of time constraint. We have shown here the investment return earned by the general insurers on their investment portfolios. we have seen that the majority of the investments of the general insurers, more than 50%, are still on the equity side. Given the high volatility on the equity side, this number will be fluctuating if we show you, say, 2020 Q4 as against 21 Q3. But we see the average investment income that we've observed on the portfolios are around 7 to 8%, and the 21 figures have been better than the 2021s. The reason for showing this slide is liquidity is a major constraint or a major need for general insurers, given the potential for large and catastrophic losses, something that's not very prominent on the life side. So the asset allocation that companies do are in line with that. So this was our recap of the general side. We have a few slides on the life side as well. The life side, in terms of number of companies, is much smaller. There are around 10 life companies in Pakistan, including the public and the private sector. In terms of premium, and I think as Nadeem Saab said in his own speech, because the savings component, the quantum of the life industry is much bigger. And this is something that we can see here as well, that the density is almost 3 times the general side. And similarly, if you look at the penetration, it's also much higher. If you just combine the previous 2 figures, it ties up with our keynote speaker was mentioning. The total penetration that we observe in Pakistan, depending on the source and the factors and the limitations, it's around 0.8 to 0.9%. On the life side, we have information for the last 3 years. We have split that across public and private. And the reason is because of the historical situation in Pakistan, where the life industry was nationalized back in 70s. It was again deregulated in 90s, and that's when the life companies started coming in. Life companies, as you all know, have a much longer break-even time period. So companies, if you see the split here, the private sector is now almost 50% of the total. State life, since the public sector only includes state life, the information for postal life is not included. But on an overall level, you can see that the market, in terms of premiums, is more or less stable. In terms of the split, also it's around 50-50. A couple of reasons which have impacted the life side is AML and CFD requirements, which were quite heavy in 2019. The performance of the equity market, which again has impacted the new inflow of money. So this slide, some of the legends might be small, but we are showing here the market share of the different companies on the life side. The left graph, because of the lion's share of SLIC, we have put down 2 pie charts. On the left side, it's with SLIC, with straight line, and the right is without straight line. If you see with straight line, it's around 50-50 between public and private. If you see without SLIC, then the top 2 to 3 companies are dominating the market with around 80 to 90% share. A bit on the channel distribution for life side. Again, this is something that's quite prominent or quite an important concept within a life company, the split between bank assurance and DSF. Different companies have different ratios. Bank assurance again has been a very strong area in Pakistan. The large network of banks, some insurance companies have group banks which they have capitalized on. So we see in terms of the total market. Now again, this data does not contain all the companies, because this disclosure of channel is not done by every company, but from whatever resources we could get the information. We saw that around 60% of the total business is coming from banca, the remaining from direct sales force, and then we have other channels like direct, we have InsurTech, we have micro. So all these other clubs in the others area. A very similar trend we also see on the life side for the conventional and the takaful split. Around 10 to 12%, 13% is coming from takaful. One thing to note here is on the general side, it's mostly corporate business, whereas on the life side, it's mostly retail business. But if you look at the split between conventional and takaful, it's more or less the same. Again, I'll just skip these slides. And a very quick slide on the persistency. So persistency, a key KPI for life companies, and this is something that's even disclosed in the annual accounts. Again, the data has some limitations, but the companies do split their numbers based on first year premiums, second year premiums, and subsequent premiums. And we've tried to see and calculate the persistency that we see Mis-selling, not even in Pakistan, but that's a global concept. This is a KPI that life companies generally follow or monitor, So we see, if you look at the first year persistency, it's averaging around 70% for the market. If we see the subsequent year, it's close to 90%. So the analysis that we can deduce from this is that if the policyholder passes the first year, then things continuing on for the full term of the policy are much higher. Similarly, acquisition costs, the dynamics and the nature of acquisition costs on the life side is much different in terms of, if we take an example which our keynote speaker was also mentioning, commissions can even exceed more than the premium in the first few years. So differentiating between acquisition and management, other management like it for general side is also good to see here. And we can see a slight downward trend on the acquisition side, both on the marketing as well as on the acquisition side. I think just as we saw for the general insurance industry, we also have the profitability of the industry as a whole as against the return on equity. Now, we flipped through the slide very quickly, but I'll just recap that on the general side, we saw that the return on equity was around 10 to 12%. On the life side, this return on equity is much higher, close to 30%. Again, return on equity is a very vast topic. It can be interpreted in multiple ways. The equity figure that we have taken is the financial book figure, whereas return on equity has other interpretations as well. But if we go by the year-end equity figure divided by the annual profits after tax, we can see that the return on equity on the life sector is almost 3 times that on the general side. Very similarly, as we saw on the general side, we have the investment picture for life side. Again, on the life side, the investments are primarily driven from the choices that unit-linked policyholders are making. For the general side, it's the proprietary investment, so it's the company's mandate where they want to invest. But on the life side, because a major chunk of the portfolios are unit-linked, so a customer decides, depending on the market situation, depending on the financial markets, whether they have to invest in a fund which specializes in equities or it specializes in debt, or it should be a balanced fund. On the equity side, we have seen a lot of volatility over the past 3 years. So the latest picture that we see, which is as at 2020 Q4, more than 3/4 of the investments are in debt securities, with around a quarter on the equity side. If we see on the investment return side, the investment return for the life company is slightly higher in the general side. The general side we saw in a range of around 7 to 8%, whereas on the life side we are seeing around 8 to 9%. Again, life companies have much higher, much bigger, investment portfolio. They have more room because there's a lot of transactional cost involved when you're investing in a portfolio or when you are reallocating. So we feel that the life companies might have a better edge, helping them attain a slightly higher investment return. That is it from our side in terms of the industry highlights, both general and life. We are happy to take any questions on any of our slides, any of the numbers, or any observations any of you might have. Okay. So if we look at the 2021, so if we add 0.52, roughly 0.7.
So it's 0.9.
Okay. 0.7, I think you're right. So it's close to around 0.7% in total. But this excludes the unlisted segment of the general industry. So if you include that, it might go up a bit, but roughly a 0.7, 0.8. We would have time for 1 or 2 more questions if there is anyone. Thank you so much. Thank you for listening, and have a good day. Thank you.